Hello, I'm Tony Kaye. I'm from InvestSMART. Welcome to today's Advisor Q&A session. I'm joined as always by my regular guests, Bruce Brammall.
Hi Tony.
And Max Newnham, both licensed financial advisors.
Hi Tony.
I'll just start off by pointing out that today's session we don't give specific advice, we give general financial advice. So we're going to be talking about things to do before June 30 this year and what's coming into effect on July 1 next year. When you have a question to ask, you can just do that through the system and put that in. I'll see it come up on my monitor next to me, and we'll be able to get to those. But I thought first off we'd really just start talking about what's coming into effect next financial year and what needs to be done before June 30. Now Bruce, you've just published an article on our website today which talks about 7 things to do before the end of the financial year. So maybe you can just recap on that.
Yeah, there's probably 15, Tony, but I limited it to 7 this year. Look, the first one that I think is critical, and look, the vast majority of people will have done this, but if you haven't, it slipped your mind, is to make sure that your salary sacrifice arrangements have been adjusted for the lower concessional contributions caps. So last financial year, FY17, you were able to put in 35,000 if you're over 50 and 30,000 if you're under 50. Both of those got cut to 25,000, which takes into account your superannuation guarantee. So if you haven't made those adjustments, you're now 10 months into the financial year. You may still go over that cap, but you still do have 2 months potentially to wipe off the last few $1,000s and not make those extra contributions, which if you go over your cap will be taxed at a higher rate. So that's probably the first one that I'd suggest. Hopefully most people have already done that though.
I've got a question because it's interesting, it goes to the heart of this, is that my understanding if you're over the concessional cap, it gets counted as a non-concessional and there are some penalties and other little bits and pieces there, but it's not huge. But then it becomes part of your non-concessional. And if you are a person who has not been able to make concessional contributions because you're over 1.6 million, by exceeding your concessional cap, isn't that another way of getting concessional contributions? I'm wondering, because it was something when I saw a client's thing came through just recently for the 17 year, where they exceeded it, and you've got the choice of taking it out or leaving it in as an after-tax contribution.
Yeah. My understanding is this time, because if you're over 1.6, you're not allowed to make non-concessional contributions, so you won't have a choice. It will have to be refunded.
Okay, so it'll be easy to send the paper. It was my devious tax brain was starting to work on that one, so they'll probably close that loophole. Yeah. But it was worthwhile trying.
Certainly, yeah. So look, anybody's got those salary sacrifice arrangements to finish off or to update because they didn't do it earlier in the financial year, will need to do that now. The second one, and this is a really important one because this is new for this financial year, is the ability for anybody who's able to make concessional contributions to be able to make them by June 30. So this came about as a result of the removal of the 10% rule. The 10% rule was if you're an employee who earned more than 10% of your income as an employee, then the only way you could make those contributions was via your employer. They've removed that rule now, so it means that any employee, say somebody's earning pardon me, $100,000, getting $9,500 in superannuation guarantee payments, they can now get around to May or June if they want and put that extra $15,500 into super, get the tax deduction in their own name, and from a tax perspective it looks and feels like you've been making the salary sacrifice contributions or arrangement for the whole year. So I'm really hoping that this rule will be taken up by a lot of people who haven't necessarily done salary sacrificing before, might have earned a little more money than they expected to this year, are looking for tax deductions, made some late capital gains in the financial year, and are looking to get a tax deduction or reduce the tax they're going to pay, and use these new rules which will allow them to put in. It might be $2,000, $5,000. It might be a small amount of money that you do on June 15 or June 20 or something like that. But yeah, for the first time, regular employees will be able to put money into super near the death knock and be able to do it. The really important thing to understand about this one though is that the contributions need to be received by the super fund by June 30, and June 30 is a Saturday this year. So if you're going to do it, BPay often takes 2 days to get there. You're going to need to do it by no later than, say, the 27th of June, so they can get in there on the 28th or the 29th. Because if you do it on the Friday the 29th and it doesn't hit the account until July 2, which is the Monday, then it counts towards the following financial year's contribution limits. So it's really important to not leave it until this year, June 29, because it needs to hit your superannuation account. Now, that'll be easy for self-managed super funds. It won't necessarily be that straightforward if you're contributing to your APRA fund.
It's interesting to understand the math on it too, because if you've made a large capital gain and you can therefore make a $10,000 concessional deductible contribution, that effectively will mean that $20,000 of the gain, if it was eligible at 50% discount, will end up having tax paid on that $20,000. That you're talking about $1,500 tax, because it'll be the 15% tax on the $10,000 compared to if the $10,000 came in, that could be anywhere, and more than likely going to be between $3,450 up to the the $4,700, $4,900. So it's a real good method of making sure there's more money sticking in where you want it rather than going to the tax man.
Yeah. And this is the first year that you're able to do that. So I think it'll take a few years for people to really catch on to this. But for anybody looking, I want to get more money into super. I deal with a lot of people this time of year, Max. I don't know if you do, who come in and say, I want a salary sacrifice. And you look at the numbers and you go, that's fine, but you're going to have to lose. If you want to get up to the maximum, you're going to have to go to your office, you pay office HR department today, and salary sacrifice most of your salary for April, May, June in order to do that, and you might not even be able to get to your cap that way. Nowadays you can take the money, you don't have to worry about the salary sacrifice arrangement with your HR department, the tax office. You can just get into June and go, yep, okay, I've got savings, I want a tax deduction, I want to get more money into super, tick, tick, tick. Here's 5,000, here's 10,000, here's whatever it is. So this is really important. It's going to be a big one. Hopefully gets a big uptake this year, but certainly will become a very important strategy in the years to come.
I don't know whether you ever looked at this too, and I know that, see, if you do a salary sacrifice, it becomes a reportable superannuation contribution, an employer superannuation contribution, which ends up having to be shown as a separate amount on your tax return, and it counts towards things like having to pay back some of the Medicare discount that comes through from the Commonwealth Government, and it counts to a number of other things, like I think your superannuation, where you're over, it's going to be from 250,000, where you're paying the extra 15%. I've often wondered, and I'm not 100% sure, whether the personal deductible super contributions, if they're not going to be shown as reportable employer super contributions, they could become a more valuable way of getting over getting the maximum superannuation and decreasing your tax than doing it through the traditional salary. It's too new in the new system to work out how it's actually going to work, but that could be an interesting side benefit that be worthwhile doing rather than the old salary sacrifice.
Yeah, I haven't looked into that exact aspect of it. I'd be surprised if the government hasn't, because part of the reason for doing that ruling is for things like child maintenance payments, and back in the 90s you salary sacrificed as much as you could, and it would reduce your income, and that would reduce how much you had to pay your ex-spouse in child maintenance, and that's why they brought a lot of these rules in. So I'd be surprised if the ATO or the government hasn't sort of said, no, this one's also going to count towards be added back onto your salary for the purposes of child maintenance, for the superannuation, the extra tax, the 15% you've got to pay. I'd be surprised if they haven't, but it might be a case they just haven't. They didn't think about it.
See, it's interesting.
Stranger things have happened.
It's interesting, I think, though, that the various rules can differ between the particular benefit or piece of legislation. Like, there are a number of Centrelink benefits and other benefits that have this adjusted income calculation, which is effectively your taxable income. You've got to add back reportable employer fringe benefits, you've got to add back fringe benefits, you've got to add back negative gearing losses and all that sort of thing. It'd be interesting to see. Yes, I can see how they might end up doing it within the child support side of things, but as to some of these other calculations, they'd have to change the calculation method of this adjusted taxable income. At the present, I can't see where one of the add backs is personal deductible super contribution. That's the way that I think they'd have to do it.
Yeah, that's probably right.
Just a couple of things I wanted to clarify. So the process for getting a salary sacrifice into, let's say, an industry super fund or a retail fund, as distinct from your own fund, what do you need to let that fund know before you make the contribution? Do you have to fill out any forms?
Well, salary sacrifice is the arrangement that's always been available to employees, but not all employees, because it's not something employers have to do. Is an arrangement between you, your HR department, and the tax office to tax you less. So
but if you're cutting out the HR fund,
if you're doing that, you make the contributions directly to your super fund, EFT, BPay, check if anybody still accepts those. If super funds still accept those, the contributions go in as personal member contributions. Now, after June 30, let's just take an example. Somebody's put in $10,000. After June 30, there is a form that you need to fill in for the super fund to let them know that you are going to claim a tax deduction for that $10,000. So you fill in the form, give it to the super fund. The super fund then reports to the tax office that you're going to claim this $10,000, and that form must be filled in and given to the super fund before you lodge your own personal tax return. So the super fund and the ATO need to know that you're going to claim this $10,000 before you put in your claim for $10,000 through your tax return. So there is an order of things to do it. Super funds are supposed to, after the end of June 30, when the new financial year starts, write to all members or email members and say, we have received member contributions from you of $10,000. Are you going to be claiming a tax deduction for this? Hopefully tick a box, sign, date, and return to the super fund. So there is a process involved in doing it, and important follow-up.
And it's interesting because, yes, there's two ways of notifying the super fund of that you are making a personal super contribution, and I'm actually going back to the old system before they've changed it, but it's the same sort of rules apply. And you're right, there was always that letter that came out or notice that came out saying, hey, you've made these personal contributions. Are they all after tax, or are you wanting to claim a tax deduction for some of them, and how much? I forget what the circumstances were, but I think it might have even been talking with one of the industry funds or something like this. From a timing point of view, they said it's actually better for us and from you from a tax point of view to take any equivocation out of it. And I think this was, if you put the money in, this is right, if you put the money in and then you're going to be rolling it out, if you haven't put in the notice at the time of putting it in, it can be classed as non-concessional rather than taxable if that's what you were wanting to do. So what they advised is if you're wanting to make 100% sure and clear that what the contribution is related to, is to actually lodge the notice at the time of the contribution. And it just removes any doubt. It means you don't have to rely on the administration of the super fund that you're dealing with, you know, sending out you the notice and all the rest of it, because I know they get it wrong. So in actual fact, to withdraw any doubt, if you're making a deductible personal super contribution, you should find out from your fund, if it's not your, if you don't have an SMSF, say, what is the form I need to provide with you, to you, that this $10,000 I'm making is a personal deductible contribution, and that removes all doubt.
A lot of the time when you're doing this too, Tony, if you're using an APRA regulated fund, is to call the fund and find out how to make the payments and tell them what you're trying to do, because there's often a little code that you have to put at the end of your BPay number, which will tell them what sort of contribution it is. So when your employer puts it in, it might have your the BPay details, your account number with your APRA fund, and it might have a 2 on the end of it for SG contributions. But if you're making a non-concessional contribution, it might be a 6. If you're making another sort of member contribution, it might be a 4. So it tells them what sort of contribution you're making by, in some cases, the last number that goes onto the BPay payment or EFT transfer.
And then find out at the same time what's the form I've got to give you to make sure that you have no doubt that it's a deductible contribution. So that's, I think that's just good work to be doing rather than relying on the super fund to come back to you. And as I said, there is this benefit that I saw. I forget exactly what the benefit ended up being, but I saw a client that had been disadvantaged as a result of putting it in, and there was something that happened where the money had to come out before the 30th of June, and because of the way the system worked, sorry, you don't get that chance now.
And the other part in the process, of course, is that once you've done your tax return, if you're using after-tax dollars as your contribution, then you should get a rebate from
Correct.
the ATO.
So if you're putting in that $10,000 and claiming a tax deduction for it, depending on your marginal tax rate, you'll get somewhere up to $4,700 as a tax return based on that $10,000. The average income earner, $3,450, being the marginal tax rate plus Medicare. People earning between $87,000 and $180,000 will be at 39 cents on the dollar, including the Medicare levy. The
least you get, I think, is the 21. So there's a 6% arbitrage between the 15% contributions tax and the 21% of even on the lowest one.
Yeah, if you're on over $18,200. Yeah.
And sometimes it's worthwhile making that as a little bit, because you can actually get it down to the point where you have to be careful. This is the other important thing.
Yeah.
Whenever you're making one of those deductible contributions, you never want to take your taxable income below a limit at where there is no tax payable. And it's not 18,200 or 300, whatever it is.
Depending on your age.
You've got to end up adding back that, under the low income tax offset, it's about 20-odd thousand that you can earn and not pay tax. If you're eligible for the self-funded retiree Centrelink offset, it's closer to 25,000. So you are hurting yourself if you make a deductible super contribution, which brings your income down to the point where there's no tax saved, but you've effectively paid 15% tax.
Okay. All right, well, we've spent a fair bit of time on that one. Let's move on to the next point.
Number 3 is, and this is the critical one for self-managed super funds this year, particularly for those who had more than $1.6 million in their fund, and that is the making the elections in regards to the capital gains tax relief. So this is parcel by parcel. Whatever assets you've got in the fund, if you had more than $1.6 million in there and you've had to roll some of your old pension or TTR payments back into accumulation, you're able to make get capital gains tax relief on some of your funds. And it's a lot of people saying, well, why wouldn't I just claim capital gains tax relief for the whole lot? Well, that's not the case, and you don't necessarily want to do that, because there may be some losses in there that you want to be able to claim the loss against future gains that are sitting in your accumulation account. So this really has to be done asset by asset and even parcel by parcel. If you've picked up $50,000 worth of BHP shares or NAB shares or whatever over the years that you've bought between the 80s and the 90s and 2000s and in more recent years, you may have some of those shares have got huge capital gains on them, some of them have some losses on it. You need to sit down and really work out parcel by parcel, asset by asset, as to whether or not you want to claim the capital gains tax relief. It's too broad to go into in this conversation. It's something you need to sit down and do yourself if you really know what you're doing, or sit down with your advisor or accountant and go through it asset by asset.
As a little accountant's tip, when I've had to do this with clients, is in a lot of cases, depending on the software that's being used, you can normally download your list of your investments, which ends up showing what the investment is, the number of shares or whatever you've got, the date of purchase, the cost value, and the value now. If you can download one of those as a CSV or an Excel spreadsheet, this is what we're doing with our super funds, is you download that, convert it to an Excel, and then you end up doing a sort of the largest capital gain item down to the smallest, which made it a lot easier to go through. The problem is, and I learnt this from bitter experience, is sometimes the reporting, and it touches on your thing about parcel by parcel, sometimes the reporting system will report an effective average purchase price. So where you've got shares that have been purchased at different times, you need to amend it for that. But it makes it a bit simpler to focus your mind. Well, why would I claim a tax concession on something that's made a $500 capital gain and is worth $5,000, when I can claim a $3,000 capital gain that's only worth $4,000? Clearly the idea is to maximise the capital gain that's been built up there and be able to defer paying tax on that forever.
There are two other important things to note about this, Tony. The first one is that you need to make these elections before you put in your fund's tax return, or at the time that you put in your fund's tax return for the FY17 year. So a lot of people will be doing that around now. The second thing is these declarations are irrevocable. You can't change your mind. If you decide that you, pardon me, don't want to claim the CGT relief on this tiny little stock that you bought that hasn't been doing well, you don't want the CGT relief on it, then you're stuck with that decision. If that stock then goes bang, does a 10 bagger over the next couple of years or so, and you go to sell it, then you're not claiming the CGT relief on it, and that'll have impacts on the gains that you've had. So it needs to be done before or at the time of lodging your FY17 returns, and your decisions that you make are irrevocable.
The other important thing, and I think we were talking about this before, is if you have made the decision to claim the capital gains tax concession, and most people are doing it at the 30th of June 2017, our subscribers must remember that the capital gains tax clock starts ticking again from 30 June 2017, not from when they originally purchased the share. So therefore, if they sell a share or an investment that they claim the capital gains tax relief and sold it before July 1, 2018, they miss out on any increase that's happened from the revalued amount up to what they sell it for. They're paying the 15% tax on all of the gain and don't get the effectively 1/3 discount.
Okay, good. Any more points on CGT relief?
No, look, I think it's one you need to sit down. If you
Yeah.
haven't done it yet, it's time's ticking. You need to get onto that.
Yep.
Next one, Tony, would be a perennial, and that is to make sure that you make your minimum pension payments on time and before June 30. You need to find out exactly what it is that you need to make as a pension payment this year, and make sure that you do that by June 30. The complication of not doing so can be that the ATO will declare that your fund wasn't a pension for that year, and you'll have to pay tax on all capital gains, all income earned by the fund during that period. So the bigger the fund, the bigger the damage is going to be on that one. If you've got $1 million super account, a super pension, and you need to pay 4% or 5%, then make sure you've done that in time for June 30.
There's a yin and yang to this, though.
Yeah.
You started off with a 1.6 report, the superannuation pension limit. You'd automatically go back to zero because everything would have had to be commuted back. So therefore, you start again. It may be a very small benefit, but
Tiny, I would think.
Yeah, very tiny.
And the losses on having to pay tax on the income and gains would be a big one. Number 5, I would probably say, Tony, is about protecting capital gains by making concessional contributions. So it's sort of harking back to what we were talking about a little bit earlier, and that is if you have made capital gains in your personal name, that being able to make a capital gain of 5, 10, 50, 20, 100,000 doesn't really matter, but you might be able to essentially reduce the amount of tax that you're going to pay on the gain by making concessional contributions to super, whether it's your self-managed super fund or APRA regulated fund. So that becomes an important one. It might be you're looking at the time of year and going, oh well, I did make a gain in January or February or last September or something, and I'm going to have to pay tax on that at some stage. I can reduce the amount of tax that I'll need to pay by for the financial year by making a concessional contribution to your super fund. So that's probably number 5. Number 6, go. Yep.
Because that's okay if you're under 65. The interesting thing though is you need people who are 65 or older need to take up that if that's been in that case, and if they have the ability, and I'm choosing my words very carefully, to be able to make a case that they satisfied the 40-hour employment
work test,
it can be well worthwhile when you think about it. If you're able to make that work test and you can make a $25,000 deductible contribution, you're effectively therefore paying only 15% tax on a $50,000 capital gain. So that's the only thing that's worthwhile thinking about. Is sometimes it can be creative, sometimes it may be having to start a paper round at the age of 73 for getting your 40 hours up, but it's something that can be worthwhile thinking about. Absolutely,
yep. Number 6 is to make the most of non-concessional contributions at this time of year. So obviously in FY17 it was $180,000 per year. That's now dropped for this financial year onwards to $100,000. But as you get to this time of year, if you're thinking about making non-concessional contributions, you and your partner have proceeds from the sale of an investment property or the sale of your home, downsizer contribution being a topic for another day, or that we've covered recently. But you want to be able to make some non-concessional contributions to your super fund. One thing to think about at this time of year is that if you put in $300,000 now, that will cover your NCCs for FY 18, 19 and 20. You won't be able to make further NCCs until the FY 21 year. But if you only make $100,000 this financial year, then potentially on July 1, when you've kicked into the new financial year, you could put in $300,000, which would cover you for FY 19, 20 and 21. Yep. So being able to get $400,000 in, if there's you and your partner, potentially being able to get $800,000 into via non-concessional contributions in just a few short months between now and July. Another important part of that is, of course, the restrictions that are placed on being able to get non-concessional contributions into super now. People with lower balance is fine, but anybody with more than $1.5 million in their super balance can only put in 1 year's worth of NCCs. If you're between 1.4 and 1.5, you can put in 2 years worth of NCCs, and it's not unless you've got less than $1.4 million in your super accounts, joint super accounts, all of them, that you can actually put in 3 years worth of non-concessional contributions, or $300,000 at a time.
That's getting back to this new term that we all have to get used to, is the total superannuation balance.
Yes, yeah.
And that's all superannuation balances, including the value of lifetime pensions and other things, and that's the new reasonable benefit limit. Effectively, we've got the pension transfer balance cap.
Yep.
But then you've got this total superannuation balance as that's the be all and end all.
Correct. Yeah. Last one, number 7, is spouse super splitting. Now this will allow spouses to potentially transfer superannuation payments made into their account for the previous financial year across to their spouse. So if you've got a spouse with a high super balance and a spouse with a lower super balance, then it will make sense, and this is something that's going to have to happen for many, many more couples than is happening at the moment. If this spouse has received their $25,000 in concessional contributions for the year and is close to their 1.6, or young enough to know that I'm probably going to go over my 1.6, then to start as early as possible, for many people in their 40s will need to start doing this, is to transfer the $25,000 less the 15% contributions tax across to their spouse, to try over time to make this one possibly grow a little bit less than this one, and both of you get to that 1.6 million together. So you can only do concessional contributions, so that'll be your superannuation guarantee, any salary sacrifice or any contributions that are made under this new scheme that we were talking about, and up to a maximum of 25,000 less the 15%. Now it's literally it goes over to your spouse as a rollover. It doesn't count towards their concessional contribution limits. So over time you can help do this and get them sort of going a lot closer together. The rules around this include that you need to do it before the end of the next financial year. So for FY17, you can still make these transfers now by getting in touch with your super fund, letting them know what you want to do, and being able, if you've got a self-managed super fund, and getting your accountant to do the appropriate paperwork, but letting them know what you're trying to do, and they can then roll that. If you've only put in $15,000 for the year, then you can only do $15,000 less that 15% contribution tax, but it's up to that maximum of $25,000, but based on whatever your concessional contributions were for the previous financial year. So if people are looking to do that and wanting to know how do I start making this situation a little better, that is one of the ways that you can do it, and should become a strategy more people are using going forward. So yeah, look, they're my 7 top ones. There'd be a bunch of others, but they're the ones that I think people need to be really thinking about at this stage of the FY18 year.
And my addendum to that last point, which is a great one too, is that knowing some of the demographics of our subscribers, it may not necessarily apply directly to them. but they can add some real value for their children or other people that are in their maybe 30s, 40s, early 50s, that to get that message across to them, if they want to maximise their super and they've been in well-paying jobs and they've been able to get some good super and they've had a situation where their spouse hasn't been earning or maybe able to make the same contributions, the sooner they do something, the greater the chances are as a couple they'll have more superannuation rather than being forced not to be able to do something from a certain period on. Because the idea is if you can keep those balances down, when someone's getting closer to retirement, as long as they're below the 1.4 million, and it's not just the 1.6, as Bruce was talking about, this non-concessional contribution limit. If they can keep it below the 1.4 and they're getting close to retirement and they may have an investment property that they've sold, or there's other windfalls that come through as a cash, if they've been able to do that for a couple where both of the members of the couple are below 1.4, there's potentially up to $800,000 that can go into superannuation. So it's very far-reaching. The sooner people do it, and the more they're aware of it, and it's not just our subscribers. It's the first and second generation going back. It's very important.
Yeah,
and it really goes to the heart of something that we at InvestSMART have talked about a lot, and that's a lot of women retire with low superannuation balances, and part of that reason is because they haven't been following this type of strategy with their partner. I mean, in some cases they may not have had a partner, but there are plenty of married women who retire with very low balances while the husband's got the high balance.
Yeah, well, look, assuming the couple stays together, in the old days it didn't matter. You could have, one member of the couple have a $10 million super balance and the other one have not a cent, and it just didn't matter. The transfer balance caps and this $1.6 million means that it does matter now, and these are strategies that you really should be starting in your 40s if you're married and one person is working or earning a higher income, the other person's out of the workforce. It's something you should be starting to work on before you get way too far out of whack. Another important part, which Max and I were talking about earlier, which is a constant source of confusion or angst about doing something like this, is that what happens if I give all my superannuation to my spouse and then we split up, whatever. Since I think 2005, superannuation is just another divisible asset when it comes to a relationship breakdown. So, whatever equities in the home, investment properties, business, superannuation, cash sitting in the bank, investments, it's all just, the way that the courts and the lawyers fighting about it do, it's just a pile of money. And whether it's sitting in his super account or her super account doesn't really matter. All these things are now divisible assets. Going back prior into the 90s, superannuation was untouchable, but that's not the case anymore. It's just another divisible asset, and this is about making sure that there's more of it potentially to divide if you start fighting and break up some point down the track. It's just good sense to do it nowadays.
And no one can ever normally accuse me of being politically correct, but in actual fact we have to say it could be his and hers now.
Correct, of course, Max. Correct.
The other thing too is from a point of view of the superannuation, the salary sacrifice, and also the super splitting. Not all super funds allow super splitting. There are some funds that don't. Now, if someone is in a fund that doesn't allow it, that is the first indicator that they are in a dinosaur fund, and we know what happens to dinosaurs. So they really need to, if they're in a fund with that, they are in a very tight super fund that has not come into the next century, and you need to use that as an impetus to be looking around for another fund, because that's the other reason why this splitting your super with your spouse sometimes doesn't happen, not just because people haven't thought of it, but the member could be in a fund that doesn't allow it.
Now, before we move on to questions, and I do ask listeners to send in their questions if they have them, but before we move on, I just wanted to briefly touch on what's happening beyond June 30, because there's some new legislation coming into effect from July 1, which again opens up some more dimensions for people in superannuation and retirement. And the two that I can sort of refer to just off the top of my head, there's probably a whole lot more, but one is the catch-up rules that come into effect.
Yep.
And we should just briefly sort of explain that. And the other is the home downsizing legislation, which we've talked about a number of times, but I think we need to point out that that doesn't come into effect till after June 30.
It's applying to any sale from July 1 onwards for the downsizing. And as far as the catch-up one, it funnily enough can make it worthwhile for people who have assets that they know they're going to end up selling coming closer to retirement, that if they're not going to get a really good tax saving, and by that I mean if they would make salary sacrifice or get up to their $25,000 limit and the tax benefit ends up being 34.5%, that it can make sense to not maximise your super contributions during that period. I think it's over a 5-year period up to is there a maximum of 100,000? I think
125.
125. So therefore, it can make sense not to end up maximising your super contributions. That this is all a part of what retirement planning should be, rather than unfortunately what most people is. They wake up in a place called retirement and they've got to put up with what they've got. If I'm going on a journey, you plan it properly. So the idea is if you can see that you've got these assets you're going to be needing to liquidate to help fund your retirement, that in the 5 years or so leading up to your retirement, if you don't claim the maximums, you could come up with, we were talking about 25,000, you could come up with $100,000 that is used as a deductible super contribution. So if you can imagine at a $200,000 capital gain that might have had $49,000 paid on it, you only up having paid $15,000, which is a major thing. So that's a really good point from that ability to carry forward your unused things. But it really comes back on everyone doing a lot more planning and looking ahead to what have I got to be doing to make sure that when I decide I'm retired and I'm not going to have the income coming in and I've got to rely on retirement assets, that's a part of the planning.
There is an unfortunate limit on the 5-year catch-up rules, and that is that you have less than $500,000 in super at the time of making the catch-up contribution. So if your super balance has grown to beyond $500,000, then you can't use the 5-year catch-up anymore. You can only use the $25,000 annual limit. So it's a great rule and will help a lot of people get extra money into super, particularly those starting businesses potentially in their 30s or 40s when they should be making contributions but don't, and they get to a point where we're now the business is taking off, the income is coming in. Wow, I haven't made contributions to super for 3 or 4 years. This year I can make a catch up payment of up to $125,000 into super, but I do need to check to see whether I have breached the $500,000. But I can see there being a big benefit for a lot of people who retire with less but sell an asset near the end. For people who are starting businesses, 30s, 40s, possibly don't do it while cash flow's struggling a bit in the first few years, but then can make these catch-up payments. It's a good rule, but unfortunately there's this $500,000 cap on your total super balance to being able to make the catch-up payments.
And this is where it gets interesting too. It's important to get the advice, because I've just been running through and I can see a situation where you've got a couple working for a long time. They decided that they really needed a holiday house. They've had their holiday house for a number of years, getting close to retirement. It's not necessarily going to be something that they want to keep going, and therefore they've got to sell the holiday house, and that will be a capital gains taxable asset. As long as they're doing it before they're 65, when they don't have to worry about the work test. I'm also wondering whether there ends up being a strategy if you've got the wife who's been the main breadwinner that's got $600,000 in super, and the husband's got $300,000, and they have met a condition of release that the wife could be taking out $200,000 from her super tax free. The husband puts it into his super, they're both below the 500 and they can make the thing. So that's the sort of thing where it's important to get the advice just as much as it's important to be looking ahead and doing the planning.
And this one's also a bit of a sleeper too, Tony, because it doesn't start until July 1, so it doesn't fully kick in for essentially the 5th financial year after that, where you'll be able to make these payments of up to $125,000. So yeah, it's a
bit of a slow burner.
It's going to be a slow burner.
Yeah, that's all right. We've got 5 years to talk about it. And the last one, which I mentioned, was the downsizing. We won't spend a lot of time on it, but that comes into effect from July 1 this year.
So I was actually talking to a client in the last few weeks who was aware of it, wanted to know what to do about it, wanted to put the home on the market. They're in an area just outside major city. Now you had to be quite, and also turning 65 in the next financial year. So what they needed to be aware of, well, can we put the house on the market and sign a contract and have it settle after in July or August? No. If you want to make this $300,000 payment, put it on the market, fine, let agents do it, but make sure that the agents are well aware and tell prospective buyers that there will be no contract signed before the 1st of July, because it's when the contract is signed, not when it settles, but when the contract is signed. So that needs to be after July 1. In the particular example of this client that I was talking to, they turned 65 in early September. So if they can get the money to settle before early, by the end of August, get a 30-day settlement or 45-day settlement or something, they'll be able to not just put in the $300,000 downsizer payment for potentially her and her husband, who is older, but may also be able to make $300,000 worth of non-concessional contributions for herself. If she can get that money in before she turns 65. So there's potentially $900,000 that they can get into super for that couple.
And the settlement could take place before they turn 65, but they can only put it in once they're 65. Is that right? So that therefore you've got to be at 65 when you make the contribution. There's the other requirement that you've got is at 100 days. There's a time period.
There is a time period.
Settlement.
I think it's 90.
90 days. So you could have that couple who have settled in August, middle August, that aren't 65 until middle of September, still could potentially, as you've said, get non-concessional in, plus be able to do the extra downsizing one after they've turned 65.
Well, and in their case, if they've got in that particular case, they could sell it. The contract might not be, it might be a 3 or 4 month settlement or something, but they had access to, or they might have access to other funds, a loan or cash sitting around or something like that, where they can put the money into super, put the $300,000 NCC into super, get that into super, and then repay the loan or whatever they've taken out with the funds from the home once it's settled. So there's some pretty good opportunities there for people. But again, most important thing is contract for the sale needs to be signed after 1 July. Anything sold before that doesn't count.
All right, I'm going to quickly move into questions because we've been yakking for a while, and but we've covered off some good stuff. So that's the important thing.
Haven't we been having fun?
We have been,
yes.
And we can't even get to your research on ancient Chinese superannuation funds this time, Max.
We'll have to leave that till the next time.
We'll leave it till next time.
Okay.
Now, first question is from Kaz. Good afternoon, Kaz. Kaz would like to know, can we please outline the rules regarding non-concessional contributions and pull forward rules in regards to the age limit of 65?
Yep.
In particular, does the contribution need to be made prior to turning 65, or do you have it in the financial year that you turn 65?
If you're able to make the contributions up to age 65 without a problem. If you end up turning 65 in a financial year but are going to make the contribution after turning 65, you must have passed the work test in that year. So it's fairly basic. Under 65, open slather. If you are doing it in a year that you've turned 65, and let's say someone's turning 65 in December, they could be making, as long as all of the other limits don't come into play, a $300,000 non-concessional contribution after December, as long as they have met the 40-hour work test in this, what will be the 2019 year.
Can they do the 300 or only the 100?
No, because they're doing it in their 65th year.
Okay. Yep.
That's my understanding of it. So, because you can do it up to age 65 and it's your 65th year.
All right. Next question from me, but I think it might be an anonymous question. Can you have segregated assets if over $1.6 million, and if so, please explain how the tax will work over the sale of assets held in a pension account?
Simple answer, no.
Yep. Didn't think so.
Yeah. Once you're over the 1.6 segregation.
The only way you can
it.
segregate it, which is something we've touched on previously, and there needs to be careful thought given to this, it can make sense to end up having two super funds. If you end up having a super fund with fairly considerable amounts in it, and let's say you've got a great deal number of assets that, for whatever reason, their potential value in 2, 3, 4, 5 years is quite monstrous. If you do nothing and you've got a fund with 50% accumulation, 50% pension because you had $3.2 million, any gain that's made with that money staying in the super fund, half of the gain is going to be taxable, effectively. Whereas if you are able to identify those assets that have the greatest potential for growth, and you rolled out your accumulation account to another super fund, and I'd probably be recommending it can not make sense sometimes to have another SMSF because of the cost, and if you're happy to lose a bit of control and maybe put it with one of the better managed industry funds or something like that, I wouldn't go anywhere near a commercial fund because they are so far down. I think I read something that the top performing commercial fund came 47th out of the top list of superannuation funds comparing the industry ones. So, but you can do that, which means that then you've got these assets with the greatest potential to increase in growth, where 100% of the gain will be tax-free. So it's just something to, you can't do segregation, but you can do other things that can protect those assets with the most potential capital gain.
Right. All right. The next question is from Anna, who would just like some information on the event-based reporting rules that apply through the ATO, just how they work, what needs to be done there.
They're not coming into effect for self-managed super funds, I think, until 1st of July 2019, because what we've got is a situation where every super fund must report by 1 July the reportable employer superannuation balance, the total superannuation balance account for every member by 1st of July. No exception. From 1st of July, funds that have members with more than, I think, $1 million in balance must report quarterly on transactions that affect the total superannuation or the pension account balance, which is effectively commencings of pensions or commutations of pensions. Now, if you're under the million, you are able to report the things that must be reported, commencing pensions, ceasing pensions, when you lodge your annual return.
Annually, yep.
Okay. Now, I've got some other questions here. So this one relates to a building that's been sold. I've recently sold a building that I worked out of for over 15 years and have retired. I'm using the 15-year small business CGT exemption. Is it possible to put any of this money into our SMSF as we've both reached the 1.6 million mark?
Another simple answer, yes, because there are several things or several concessional contributions that are affected by the total superannuation balance. Small business is one of them. I think it's the personal injury type contributions that go in, and the downsizer.
The downsizer, yep.
So those three are the only contributions that are not affected by a total superannuation balance. So yes, and you can get up to about $1.1 or $1.2 million into a super fund as a result of that. But remember, it must end up being only the gain. So if you sold something for 1.3 million and your gain was 600,000, you can only get the 600,000.
Yeah. You need to speak to your accountants and quickly.
Very complicated area,
yep.
But yes, it's possible.
All right. Next question. what are your thoughts on having your children as directors and contributors to your self-managed super fund? I realise now, this is a bit of a longer question, I realise now that as of July 1, 2017, we are going to have to determine all capital gains on all our shares up to July 1 to reset for the capital gains tax exemption, as we're in pension phase while the children are in accumulation phase. So it's no easy task, as we've got 30 stocks that go back 20 years within our fund. What's your views on that?
Well, it's actually got less to do with the investment and more to do with the complications that can arise upon the death. Pardon me, upon the death of a member. There's just a lot of superannuation law where this can create problems. Let's say Dad dies. Money is supposed to go to designed. The will was that it go to the mother, but you now have 3 directors of the corporate trustee left, and decisions can be made that aren't necessarily in the going towards the wishes of the deceased. It's a very special area of law, and something that needs to be taken into account. On that investment side of things, you need to sit down with somebody and have a proper chat with them about the tax implications of having the kids in the fund, because there can be some issues there if you're talking about being over the 1.6 and needing to sort through the capital gains tax issues that have arisen. Then please sit down with somebody. It's a little too complex to give much advice here now.
From having been involved in the administration of super funds for more than 20 years now, the simple answer is, unless there's a darn good reason to bring your kids into the super fund, don't. The administration, especially when they're individual trustees, and there shouldn't be an individual trustee in super funds now anyway, it just, because of the documentation that must be signed by all individual trustees, and in some cases with investments, even if you've got 4 directors of a trustee company, it doesn't matter what the trustee company allows, there are some fund managers and other people where all of the directors have got to sign. It adds a degree of bureaucracy and administration that's not required. If they're doing that, if they're wanting to do that, it makes it easier when either the husband or the wife dies, again, don't have to worry about it, because the beauty about having a super fund with a corporate trustee is you can have an individual director, shareholder, being the person that's in charge of it. And even then, and what they really need to be doing is speaking to an estate planning lawyer, probably better, because the important thing is to make sure the documentation is in place so that the person that they want to look after the superannuation fund and have it distributed in what they want to do when they die, it's important to have in place the documentation to ensure that A, binding death benefit nomination could be, but also to make sure that the person who becomes their personal legal personal representative who takes over control of the fund is someone who they know, through whatever reason, is going to meet their wishes of the way they want to deal with it. That's more the way to look at it.
All right. Now we're getting closer to the time. Another question here. Having just returned from overseas for a family bereavement, got me thinking about what the effect would be of the death of one of a couple who have both allocated pensions where each other have been named as the reversionary beneficiary. The specific thoughts are, to what extent does the reversionary have to change the pension account of the deceased member? For example, make switches, change pension amounts, make lump sum withdrawals. And the second part is, would the reversionary be able to manage the 2 pension accounts to save on fees?
There's a process that now needs to be followed as a result of the pension transfer balance cap. The first thing is, there has to be an assessment done at the date of death of the value of the pension for the person who's died, and also the value of the pension, or the pension transfer balance cap, the balance of their situation. If the 2 amounts, the deceased person's pension and the surviving person's pension, don't add up to more than 1.6 million, don't worry about it. There's no great deal of administration costs. That person now has 2 pensions, one which used to belong to their deceased, one which is theirs. They need to change their administrator. If their administrator wants to charge them extra fees, nothing really changes. And as long as they've got a corporate trustee, again, they go from a point of view of having to maybe have 2 directors, they've got 1 director. So very simple. If on the other hand, they end up being in excess of the 1.6 million, they need professional advice as to work out, because depending on the makeup of each of the pension accounts, it could make sense to keep the reversionary pension and commute some of the pension of the surviving spouse, or vice versa. The problem is, in a death benefit pension, because a reversionary pension becomes a death benefit pension, you either have the choice of taking it all as a pension or all as a lump sum. You don't get the choice of saying, I'll take this little bit out, it's the excess. So it's a really important time when, especially if people are going to have a balance over 1.6, they must get professional advice.
And I think in that sort of instance, you've got 12 months from the date of death of the deceased to be able to actually make that decision on which pension, if you're over the 1.6, which pension you're going to keep in full and which one you're going to partially commute or fully commute. And
the other important thing is, that's why you can always pay a death benefit pension. But the trouble is, when you pay a death benefit pension that's just because that's what's been decided, the value of the death benefit pension is the value of the member's account at the time the death benefit commences. If you do it as a reversionary, it's as at the date of death. So you could have a situation, if it takes a while to wind up things, that you could have a situation where a person's value of their pension was 600,000 when they died. We have a rally, world peace is declared, and the American president finds a brain. Markets go crazy, and we've now got $800,000. The value of that pension now, if it was a death benefit pension, is 800,000, not the 600. So that's the other benefit, having a reversionary pension, and you get that 12 months to decide what you need to do.
All right. We've just about run out of time, so all I would say is just a recap for the listeners. You really have to start doing things right now in terms of June 30 this year. So read Bruce's article, read Max's many articles as well, because we talk about all the things that you know, are in place, coming into effect, and especially those that need to be done over the next, 6 weeks or
2.5 months, 10 weeks.
10 weeks, all right, I can't count, but we're running out of time, and doing things early rather than at the last minute will always save a lot of grief afterwards. So thanks again for joining us for Advisor Q&A today. We'll be back again next month. Closer to the time, it'll be post-budget, so we'll be talking about any initiatives that come out of the federal budget in the next few weeks. Plus, we'll be recapping again on things that need to be done before June 30, because it's important just to keep emphasising that. So thanks for joining us again, Bruce and Max.
Pleasure. Thank you, Tony.